Good afternoon, ladies and gentlemen, and welcome to the second Financial Stability Forum for 2024. My name is Murarama Mburu, and I'm going to be your program director for this afternoon. Today's panel is led by Governor Lesetja Kganyago, and he's joined by our deputy governors, as well as colleagues from the Financial Stability Department. Today, we'll be releasing the second edition of the 2024 Financial Stability Review. This review is part of our statutory mandate to protect and enhance financial stability in South Africa. Through the FSR, the South African Reserve Bank communicates the assessment of South Africa's financial system over the last 6 months and identifies and assesses the risk to the financial stability in the next 12 months. We also provide an overview of policy steps that have been taken by the SARB. Our program today will be started by the Governor, Lesetja Kganyago, who will give us his opening remarks, and then he'll be followed by Dr. Nicola Brink, the head of the Financial Stability Department. At the end of the presentation, you will have an opportunity to do questions and answers for all those in the room, as well as those who are following via live stream. So now I'll be giving over to Governor for opening remarks.
Thank you very much, Muraro, and welcome all of you to our Financial Stability Forum, the second one for 2024. We have a new Financial Stability Review for you, and this forum provides an opportunity to discuss our financial stability assessment with you. The direction of travel for South Africa is a clear one. This year has been relatively good. And the last part of the year had even been particularly better than the first half of the year. We can see in financial markets how some of the risk premium attached to the country has been priced lower. The rand, which often behaves like the share price of the country, has outperformed most peers for the year to date. Internationally, when people discuss how this year of elections has played out, South Africa is invariably cited as one of the good news stories. Our democracy is 30 years old, and like many 30-year-olds, we can look back at some periods when we were younger and regret some unfortunate behavior. At the same time, at 30, we have some maturity now. We are all grown up, and this maturity has been getting some global recognition. Unfortunately, even if South Africa has had a relatively good year, it is difficult to be so positive about the world as a whole. We central bankers are polite and are very careful with the use of language. We like to play it clean. We use obscure words for harsh and difficult things. We don't say there are wars being fought, we say there is geopolitical risk. We don't say the global economy is breaking into camps. We say there is geopolitical fragmentation. When certain election results suggest there are going to be some disruptive policy changes next year, we don't have a good euphemism for that yet. But we might say global macroeconomic conditions are tightening, as we did in our most recent MPC statement. Regardless of the language, though, I think it is clear to all of us that the global environment is becoming more challenging. We are going to have an opportunity to see this up close when we host the G20 next year, and I am not expecting it to be easy. Overall, our worry committee still has some work to do, and probably a lot more to worry about. In this FSR, we identify and analyze 6 risks to domestic financial stability. These will be unpacked in the presentation, but to summarize, they are You guessed it right. Escalating global conflicts, deteriorating public sector debt ratios, rapid capital outflows amid declining financial market depth, increased financial distress in households and small enterprises, critical infrastructure failure, and remaining on the FATF grey list over the medium term. We also identify certain long-standing or structural risks, such as South Africa's low and inequitable economic growth, the implications of climate change for the financial sector, and the ever-present risks of cyber attacks disrupting the financial system. There are also a few other interesting pieces of content in this FSR which I would like to draw your attention to. First, we are introducing a revised residual and vulnerability matrix, or the RVM, which aligns the South African Reserve Bank's financial stability monitoring and assessment framework with the approach of the Financial Stability Board. The RVM summarizes the vulnerability of the financial system to key financial stability risks after taking into consideration both mitigating and amplifying factors. The main message we are conveying here is that in aggregate, our regulated financial institutions remain resilient as measured by their ability to maintain adequate capital and liquidity buffers to absorb shocks. Second, we describe a new financial conditions index for South Africa. The goal of the Financial Conditions Index is to summarize through a single index how easy it is for firms, households, and government to access finance. We have used FCIs for some time, but this last iteration is intended to simplify and to also be more inclusive, hopefully giving us a strong shared starting point for evaluating financial conditions. For those of you who are interested in the methodological details, we are also publishing a paper on our website detailing the new index. Third, we have some analysis of the counter-cyclical capital buffer, which we are moving to 1% over the course of next year. This decision, which was first announced a year ago, is intended to achieve what we call a positive cycle-neutral capital buffer. In plainer language, this means, on average, we want this buffer to have a positive value, leaving room to cut it during downturns. The analysis outlined in the FSR suggests the move up to 1% will have a modest and temporary impact on credit extension, not severe enough to outweigh the long-term financial stability benefits that a counter-cyclical policy tool brings. Fourth, we have an interesting box on how South Africa's supply of high-quality liquid assets is evolving. As you know, in 2022, we introduced a new monetary policy implementation framework, replacing the shortage system with a surplus system. This has contributed to a change in the SARB's liabilities. Previously, we used to drain liquidity by issuing a variety of liabilities which mostly didn't count as HQLA. Now we have a surplus system, and the supply of bank reserves have more or less doubled. These reserves are excellent HQLA because you never have to worry about liquidating them, and they always keep their face value. They are cash balances held in the national payment system, the purest form of rent liquidity. The box shows that the share of these bank reserves in banks level 1 HQLA has risen from about 12% to 20%. An interesting shift. Let me bring this to the close and thank you once again for joining us today. It's been a year of hard work, and I'm sure many of you with the December holidays were here already. We should nonetheless feel some satisfaction with our efforts, the efforts of many people here today in ensuring our financial system stays strong. I now hand you over to Nicola Brink, who will present an overview of the Financial Stability Review.
Thank you very much, Governor. My presentation summarizes the key sections of the Financial Stability Review as set out here. I'm not going to go through the whole contents. I'm going to start right off with explaining the financial stability mandate of the Reserve Bank, which we normally do at the start of each of these events. The Reserve Bank gets its mandate to protect and enhance financial stability from the Financial Sector Regulation Act. Chapter 2 specifically sets out all the responsibilities of the Reserve Bank in this regard. Financial stability is defined in the Act as the ability of the financial sector to perform its functions without interruption despite changes in economic circumstances. That requires that financial institutions and markets should be resilient to shocks and able to intermediate funds in a crisis, and also that the public maintains confidence in the system in all circumstances. The Reserve Bank executes its financial stability mandate within a structured framework. We set out this framework in 2 documents that were published earlier this year on our website. If anyone is interested in that, it's some good reading. Not all the risks in the financial system necessarily have implications for financial stability. For a risk to enter into our monitoring and assessment framework, there should be a clear transmission channel to financial stability. To assess the probability as well as the likely impact of a risk, both mitigating and amplifying factors are taken into account to determine the residual vulnerability of the financial system to a risk. If the residual vulnerability is very high, the Reserve Bank could consider potential macroprudential policy interventions. The FSR starts off by summarizing key global developments and risks that could have spillover effects to the financial system in South Africa. In the period since the previous FSR, geopolitical conflicts, can't say this now anymore, have escalated, and the record number of countries have had elections, in many cases resulting in a change of government or coalition governments. There are growing concerns about ballooning public debt levels globally, which now stand at 94% of global GDP and expected to reach 100% of global GDP by 2030. That's according to the IMF. Policy divergence among advanced economies seems more and more likely. All of these factors result in heightened uncertainty, a high sensitivity to economic news, and financial market volatility. The graph on the left, you don't have to worry about what is what, but it generally shows how several volatility indicators have increased since the beginning of the year. On the right, it shows the expected interest rate decreases in advanced economies, supporting some easing in global financial conditions. I'll move over then to the domestic developments and risks. South Africa faced various idiosyncratic risks and challenges over the past years. We have elaborated on these in our previous editions of the FSR, but since June 2024, there has been some respite after the formation of the Government of National Unity. Improved sentiment had positive effects on the financial sector, and South Africa outperformed its emerging market peers in various respects. The graph on the left shows how South Africa's sovereign bond spreads have declined to below the emerging market bond index spread, or the MB spread, since June 2024. It was further supported by an improvement in the sovereign credit rating outlook. In contrast with the currencies of most of our emerging market peers, the rand has appreciated by almost 6% against the dollar in the year to the end of October, before retreating somewhat after the US elections. The JSE All-Share Index has reached new highs, and there has been net foreign investment inflows into the domestic bond market. The Financial Conditions Index compiled by the Reserve Bank gives an indication of the ease with which firms, governments, and households can access finance. Financial conditions have eased somewhat since the previous FSR, but they remain tight relative to the historical average. The zero line is the long-term historical average, so above the line is tight conditions. The main factors contributing to tight financing conditions are equity and exchange rate volatility, high long-term yields, declines in real house prices, and a decline in bank credit to households. There's a paper available on the SARB website that explains the compilation of the FCI in detail, and in the document itself you can see the subcomponents of the index. This diagram shows the key risks that the SARB focuses on in this edition of the FSR, which were mentioned by the Governor in his introductory remarks. In the following slides, I'll discuss each of them separately, but let me first explain how to interpret the diagram. The dots indicate our assessment of the residual vulnerability of the financial system to each of the risks. Residual vulnerability is based on, firstly, the probability that the risk could materialize within the forecast period of 12 months. And second, the likely impact should it materialize, taking into account mitigating and amplifying factors. The further away from the center the dots are, the higher the residual vulnerability of the financial system to a specific risk. This is the first time that we present residual vulnerabilities in this way. In future, it will also be possible to show changes since the previous FSR. It should be mentioned that there are significant overlaps and interplays among the risks, so while I'm going to focus on them one by one, they should not be seen in isolation. As global conflicts escalate, the consequences for financial markets are likely to be a flight to safety, capital outflows from emerging markets, high market volatility, and currency depreciation. Inflation could be reignited by transportation costs, trade bottlenecks, and rising commodity prices, which may slow or, in a worst case, even reverse the decline in global interest rates. An increase in tariffs and practices like nearshoring and friendshoring could further affect global economic growth and inflation, with divergent effects on markets and regions. Foreign funding may become scarcer and more expensive, and there is likely to be an increase in politically motivated cyber attacks. The reason why I put the risk off on every slide is just to say that this is not a forecast. This is just a what-if assessment. South Africa's fiscal position has long been on our list of systemic risks, in particular given the high exposure of the financial sector to sovereign debt. There have been some signs of consolidation in the recent medium-term budget policy statement, and the JFECRA transfers and tax revenues from the introduction of the two-pot retirement system should give some relief in terms of government's financing needs. Lower yields and policy rates are also positive for debt servicing cost. However, the debt level will keep growing as long as interest payments on outstanding debt exceeds the primary surplus. The fiscal position remains vulnerable to shocks and faces risks in the form of weak SOEs and, among other things, inflation, public wage increases above inflation. In the banking sector, government debt is zero risk weighted for capital requirement purposes for banks on the standardized approach for credit risk. This means that banks are not required to hold capital against these exposures. There's also a possibility of an overvaluation of government bond portfolios if they are not regularly marked to market. And this may result in realized losses in an event where a bank has to sell bonds as a result of a liquidity squeeze. The financial sector remains the main funder of government, while the proportion of non-residence holdings, that's the purple line on the right graph, have steadily declined since 2017. The financial sector has taken up the slack. Asset managers, as is to be expected, are the biggest holders of government bonds, the largest portion. That's the dark blue line, followed by banks, the orange line. This is one of the new risks that we added. From March 2023 to July 2024, non-performing loans of banks increased by 47 billion rand to 304 billion rand, and the NPL ratio rose to 5.7% of total loans. This is well above the long-term average. As shown in the two graphs on the left, the worst performing portfolios are credit to small and medium enterprises, as well as unsecured credit to households, with NPL ratios of 8.7% and 15.6% respectively. Mitigating factors are the fact that banks manage their credit risk well, with sufficient provisions made against non-performing loans. The graph on the right shows an increase in bank provisions, and the coverage ratio, that is it's red here, pinkish reddish line, is well above its long-term average. Interest rate decreases should also provide relief. Nevertheless, this is a trend that the Reserve Bank and the Prudential Authority are monitoring closely. As an emerging market economy with insufficient domestic savings to fund its development needs, South Africa is dependent on foreign investment, and it is vulnerable to sudden capital outflows. Lower participation by foreign investors in our markets also contributes to lower market liquidity. The associated effects of this risk are severe exchange rate depreciation, sharp valuation changes, a higher risk of market malfunctioning, impaired price discovery, and reduced diversification opportunities. The improved investor sentiment since the formation of the GNU serves as a mitigating factor, and as interest rates in advanced economies decline, appetite for higher yielding emerging market assets may increase. Previously, we had insufficient and unreliable electricity supply as one of our key risks. Load shedding has improved significantly in 2024, and the risk of an electricity blackout has receded, mainly due to an increase in alternative energy sources. However, the deterioration in other critical infrastructure, such as roads, railway, ports, and water, have become more evident. This poses direct risks to the financial sector by potentially interrupting their operations, but it also poses indirect risks through the impact on their clients and the broader economy. Many municipalities are in a precarious financial position, and this not only poses credit risk to their financiers, but also affects their service delivery, which again has an indirect feedback loop to the financial sector. The Financial Sector Contingency Forum, or FSCF, continues its work on business continuity and crisis preparedness. And just as a little bit of background, the FSCF is a forum of market participants, industry associations, regulators, and the Reserve Bank. Among other things, one of the initiatives is to put in place direct alternative connectivity between key nodes in the financial sector. The impact of South Africa's landing on the FATF grey list has been discussed in previous editions of the FSR, so I'm not going to repeat all of that. Just to say that good progress has been made in addressing the findings. We currently have only 6 of the original findings still outstanding. South Africa has another reporting cycle in February 2025 before the FATF plenary sits in June of next year. The point remains that the longer South Africa remains on the grey list, the more entrenched some of the impacts on the financial system may become. Then lastly, we note the perpetual or structural risks. Low and inequitable growth is the root cause of most of the other financial stability risk. The physical and transition risk of climate change are going to be with us for a very long time, and the risk of a cyber attack with systemic impact is always looming. This brings me to the policy actions and the initiatives that the Reserve Bank's Financial Stability Committee took to increase the resilience of the financial system. The phasing in of a 1% positive countercyclical capital buffer will commence in January 2025. This will give the Reserve Bank policy space to provide capital relief to banks during a period of financial stress. The sovereign financial sector nexus is closely monitored by both the Prudential Authority and the Reserve Bank. As mentioned, the FSCF continues work on crisis preparedness so that the financial sector can continue to provide payment clearing and settlement services even in a crisis. There is ongoing collaboration with the National Treasury and the financial sector regulators through the Financial Sector Oversight Committee, and this is intended to share information and to coordinate actions. The FSCF also has a subcommittee that focuses on collectively enhancing the financial sector's cyber resilience. That concludes my discussion of the risks. This is just then to mention, we have 3 briefings on selected topics in the second part of the FSR. The first gives a brief overview of the results of a study on the economic impact of the 1% positive CCYB. The findings, in short, are that the impact on credit extension and the economy are likely to be marginal and temporary, so it self-corrects, and the financial stability benefits outweigh the costs. The second briefing is about the changing composition of high-quality liquid assets in South Africa following the introduction of the new monetary policy implementation framework. And the third briefing summarizes the main findings of a comprehensive study on the South African commercial real estate sector and how it may impact financial stability. The sector is under pressure from both income and cost sides, and this pressure stems from both structural and cyclical factors. This paper is already available on our website on the financial stability section. The impact of the CCYB is a forthcoming paper that is just undergoing the review process. So in conclusion, the financial stability prevailed over the review period despite global and idiosyncratic disruptions and risks. The outlook has improved since the previous FSR on the back of a better fiscal outlook, a decline in load shedding, lower interest rates, and more optimistic investor sentiment. However, perpetual and structural risks remain relevant, and two new risks have been added, as shown there. This is the end of my presentation. As a very, very last comment, I just want to thank all the staff of the Financial Stability Department and elsewhere in the Reserve Bank who worked hard on providing content to the FSR, and the editorial team who put it all together. Back to you, Governor.
Thank you, Nicola. To open, I must thank you for leading a very difficult group of staff. Okay, so that's the presentation. We are up for to take your questions and comments. Compliments are also particularly welcome. Yanni?
Thank you, Governor. My name is Yanni Rousseau from Wits Business School. As you said, the compliment is particularly welcome. I have to compliment the bank on the special bank indaba issue on Governor number 8, Mr. Tito Mboweni. I couldn't attend the memorial service and I've asked for a copy. It is really a very, very fitting tribute for which I must compliment the Reserve Bank. Then I have a question on CODI, the Corporation for Deposit Insurance. Now, at the outset, I must say I am really in full support of CODI for the simple reason that the average South African has thought for the last 50 years South Africa had a deposit insurance scheme. For reasons I don't understand, but so it is just fitting that we have one. But on a previous occasion, I received this brochure explaining CODI, and on the back page is a little diagram explaining the various role players within the banking industry. But it has occurred to me that the National Credit Regulator is not shown here at all. And my understanding is that banks are also subject to supervision by the National Credit Regulator. So my first question, therefore, is why not? And secondly, what is then the link of the National Credit Regulator via the banking sector into CODI, given the omission from this document? And then thirdly, whether it is not time to bring the National Credit Regulator into the Reserve Bank under the auspices of the Prudential Authority, whether that is not the way forward to get a more structured supervision and regulatory structure. Thank you, Governor.
Thank you. Yanni, any other question or compliment?
Thank you, Governor. My name is Kamohelo Malfetani from Standard Bank Group. My question is, I have two actually. My question is from Nicola's presentation. I saw that when it comes to the financial situation of the households in South Africa for an average citizen, it's pretty tight. So I wanted to know what is the Reserve Bank's policy kind of like doing with regards to that, and if the direction of the policies in place are directly to benefiting or improving the financial situation of the average South African citizen, or it's just policies focusing on benefiting the entire market and hoping indirectly the average South African citizens also benefit. Thank you.
Good afternoon, everyone. Mpomolo Piani, Alex Forbes. My question is on grade listing, and I just wanted to find out the progress. I know we just did a review in October, but I'm curious with regards to the 6 remaining action items. I'm just want to know what the progress there is, and the likelihood of us ticking all the action items come February next year. And the reason I'm also asking is because I saw on Nicola's presentation that she expects that if we don't exit the grey listing come mid-year, then the cost associated with us remaining there for long, or rather the adverse impact, could escalate. And I just wanted to know your thoughts behind that. Why do we expect it to escalate when the status is not necessarily changing? Yeah, thanks.
I'll take the last one. When I'm saying like the fifth one. Anything online? No? Okay. This say, you know exactly what I'm going to ask you to do. Yani, the NCR deals with conduct. So if it has to complete the Twin Peak, we think it should be with the Financial Sector Conduct Authority, not with the Prudential Authority. Because they don't deal with prudential issues. They don't deal with the safety and soundness of the credit providers. They deal with the behavior and conduct of the credit providers, how they are treating their customers. So the credit providers could be banks, as it happens in South Africa, furniture companies, machinistas, and all of those. I'm not think that we are geared to be able to regulate those, and I think that the Conduct Authority would do well in that. And why was the NCR not included in that? That picture was painting for you the Twin Peak model. If we put them in there, there might have been a rebellion to say that they are outside of the peak. But the sentiment that you express featured in South Africa's peer review by the Financial Stability Board in 2012, that they do not see why the NCR should not be part of the Financial Sector Conduct Authority. It's conduct in the financial sector. It just made sense for that to happen. Grey listing. I can understand your impatience. I'm also very impatient. Literally, the progress was reported just less than 30 days ago, and in a typical South African attitude, we didn't lose because the other team played better than us. We lost because we are just playing so badly, right? So I can understand. I can understand your impatience with that. The six that are remaining have to do with, a lot of them have to do with prosecutions and all of that, and that's why we highlight that it is the last hurdle is going to be very difficult. It's like trying to lose weight. If you get told you are obese and you must lose weight, the first week or two, the kilograms go away very fast, and as you get closer to the target weight, it becomes very difficult to shed the weight. I can talk from experience. There isn't, you say policy about helping the average South Africans. So, I hear this thing, average South Africans, men in the street, which is a very important one because that doesn't, like, there are no women in the street, right? And people are exposed to debt. And I would love, Nicola will give you a very technical explanation just now. But here comes the thing. Debt is an outcome of decisions taken with respect to income and expenditure. As a salaried individual, you have got fixed income. And if you do not live within that income and you try to stretch it beyond itself by going to borrow money, you can survive if you use that money to acquire long-term assets. But if you're going to use it for consumption and just plugging that hole, you then get into trouble, and then you will then start to ask, what is the bank doing about it? And I'm just looking at you, I'm asking, what is your bank doing about it? No, I wouldn't do that to you. At the point here, what we were trying to highlight is that in the middle of the COVID shock, there was a sense that people were stopped from earning income for very good reasons. And because they do not have income, they cannot service their debt. And because they do not have income, they cannot fund their expenditure. Government's response was to provide a grant. The response of the landlords was to say to households and businesses, we can defer the rent. The response of the banks was to say to the borrowers, pay whatever you can pay, otherwise let us know when you can pay. And when the reopening came, many people started to service their debts. But once that lockdown was lifted and people could go around their normal work, the regulatory relief that was given to the banks was now getting withdrawn. And in most instances, banks withdrew it before we could even withdraw it. And the reason is not hard to find. There was a quid pro quo. We said to the banks, you can get this regulatory relief, but if you get this regulatory relief, you shall not pay bonuses and you shall not pay dividends. So they looked at their own situation and they felt they would like to pay bonuses and dividends, and they said, you can take away the regulatory relief, we do not need it anymore. So there was that quid pro quo. Those measures were taken in the middle of a big shock. They were not measures that you keep on going over time. The only other measure, that relief that you would then get from the South African Reserve Bank, and underline this, provided that inflation declines and stays within target for a sustained period of time, then the Reserve Bank can provide relief to the broader economy. Now, you say to the market, there was a minister, I must be careful, he used to call it amorphous. But the point here is that when you adjust rates, it affects everyone, savers and borrowers alike. And guess what? The ones who benefit the most are actually indeed the borrowers. So that is the relief that it had come in tranches of 0.25%. And the focus here, this could be done because inflation had declined and inflation was behaving. And we expect that going forward, inflation will remain at our target of the midpoint of our inflation target range. You see, Mampo, I can answer your question. You see, I helped you this time. Okay. Anybody wants to add anything? Shall I take the next round? The next round, I'm distributing it to them to all of you guys.
Yeah, so maybe just on the tail end of the grey listing question, you asked him for why it's here in this report. And it's important to highlight what Nicola flagged in her presentation. This is a residual vulnerability matrix. So this is different from the way that we used to think about risk assessment matrices. So when you have a risk, the risk is always there. The difference between a risk and a vulnerability is that it's the mitigants that you can apply. So the risk is there. If after you've applied all of the mitigants that are available to you, there are things that you can't control, that is the residual vulnerability. So what the team had to reflect on here is there is work that is being done in country. Is there a potential vulnerability? Yes or no? And their conclusion is that there is. And the vulnerability is the way that FATF measures how you're doing. And the first part of the measure, which is the technical assessment, we are on track there. I think that there's one element that we think we will pass on. The second area, which is around the effectiveness and whether you can remain effective on a sustainable basis, is based on the cases that you place before them. And for some things, because you have the legal system that you have, you can't say, I've passed, I've done this, when you still have court cases that must still go through the judicial process. So you present to FATF what you are done with at the time, and some things might still come through later. And that might place us into this realm of the residual, that there might be residual vulnerabilities that we can't control, and that talks to the governor's point of, well, we will find out as we get closer to the time. But the team was just looking at potentially, once we've taken all of the mitigants, could there be potential issues that could arise that are outside of our immediate control? I hope that helps you.
Any other questions? I see none. Nicola's presentation was thorough. Anything online? Oh. You spoiled for choice.
Questions online, Governor. So we have 3 questions. One from Chauke O2 is asking, the presentation mentions climate change as one of the key residual risks facing the financial sector. Can you please tell us what initiatives the SARB is embarking on to mitigate the impact of climate change on the economy? Another question is from Given. Given is asking, would the potential incoming policy shifts driven by the president-elect of the United States that could influence global markets, how is the SARB preparing to mitigate the risks of increased global financial volatility, particularly regarding capital flows, exchange rate pressures, and the country's fiscal vulnerabilities? And then we also have a question from Vui Swa, who's asking, following the recent South African sovereign credit rating developments, does the SARB expect the fiscal outlook and foreign investors' sentiment to improve? And will this improve the uptake in government bonds by foreigners and lower the elevated risk premium?
Rashad, you will see this chap is like a central banker. He talks about policy shifts in the United States. You can deal with that, and Fundi, can you deal with climate change? Mampo? Credit rating outlook change and the impact on foreign investors participating in South Africa. I'll leave that with you.
So I guess that we come to this meeting wearing our financial stability hat, and just a week ago we were wearing our monetary policy hat. So in one sense, we look at different facets of the risks. In another sense, it may be artificial to disconnect the two because, they mean different things. So in our conversations with analysts and so on in the monetary policy, what we call post-mortem, for want of a better word, is that we emphasize that change in the global picture, whether it's not so much Trump we're emphasizing, what we're emphasizing is his set of policies that he espouses, which we don't know will become a reality, there's a likelihood it would come, has several implications that maybe we would have not had we had a different outcome. Two of the most important that is associated with the outcome is one that you may have more tariffs. That is an economic issue. It's a cost issue. It's not a financial stability issue. The second could be a financial stability issue, and that is if a particular posture of a new president in the US is associated with more inflation, it does mean that we continue to face the challenge that we have been facing for the last year or two, and that is that when investors sit abroad and say, okay, where am I going to invest in the world? Firstly, I have a Fed funds rate that's this percent, and I can get 5% for a short-term treasury or a bill in the US, and anyone who wants to invest anywhere else in the world must meet what is often a highly liquid, risk-free rate. So I guess this is our challenge. It's an ironic challenge because what you're basically saying, we don't want the Fed funds rate to give us such a high return, or the Treasury to give us high return. If the returns are lower, it's good for us because we can offer a better return. So I think that what Nicola talked about, capital flow movements, we have for many years been obsessed with this notion of a sudden stop, and we often come to the conclusion that we worry less about a quantity effect, we worry less about capital drying up, but we worry about a more serious effect, a long-run effect, and that the cost of capital becomes more expensive for us. Nicola talked about financial conditions, so this could be associated with more tightening financial conditions, and that's how, under the umbrella of financial stability, we think of the risk as opposed to putting on the monetary policy hat. Not surprisingly, the chair of the Financial Stability Committee often talks to the chair of the Monetary Policy Committee.
Yes, Rashad, lots of people have to talk. Eh? It was good that they got to talk earlier to respond to Kamohelo. On climate change, the South African Reserve Bank does not sit with the tools to mitigate. So, and I think as we think about climate, it belongs into the spectrum of environmental policy in a more holistic way, and the mitigants sit elsewhere. And in a large part, that is the work that sits in other parts of government. We do, however, have to worry about the risks and understanding how the risks are likely to materialize and where they sit in the system. So we firstly, from a broader macroeconomic situation, we have to understand what are the potential inflation risks. And if we do have climate risks that materialize that have got inflationary impacts, we need to reflect on our reaction function because it's a structural change that comes up in the economy. And there we are doing work to understand how do we model, talk to various players so that we understand how it is that prices in the economy are likely to be affected. The second part through which climate change has an impact is it would likely have an impact on capital flows, on financial market, on the pricing of risk, depending on how different market participants, on how different countries use different instruments to persuade us to move towards greener initiatives. So from an export point of view, there might be things like border adjustment taxes coming through from other jurisdictions. What do they mean for us? If we have got investors that are utilizing their funds and they say we will invest more in greener initiatives, what does that mean in terms of the flow of funds that are available in the market? Does it mean that there's a compression in terms of the funds that are available for certain activities in the economy? And this is something that we have to understand. The Governor highlighted earlier that the Prudential Authority looks at the safety elements for both banks, insurers, and market infrastructures. We have to understand how those entities would be affected. If, for example, banks are now taking deposits from entities that would suddenly not be growing, or they are extending credits to those enterprises, we have to understand what happens if they are unable to pay. And also the posture of banks. The banks themselves might decide who they lend to, who they don't lend to. On the insurance front, we have to understand insurance coverage and what does that mean. So those are the things that we have to look at, and then we must aggregate in terms of the broader financial stability implications. Will the financial system be able to hold? And then lastly, we have to look at some of the financial regulatory instruments to say, do the rules that we have in place allow financial institutions to play a role in terms of climate finance and how that would work? And that is work that we are all doing within the South African Reserve Bank. We have to work with other agencies, though. As I said, we are not the owners of the mitigants, so we have to work with the rest of government in understanding what they're doing. We have to work with the South African, with the Financial Sector Conduct Authority to understand what they're doing, as well as the financial institutions themselves, and that work has started. DJ Modise?
Thanks, Fundi. So in terms of S&P or the outlook, I think they base their decision, one, on positive sentiment. I think a lot of investors, even S&P, have priced in. They didn't think that GNU would be as positive, so that outcome was good. They looked at where inflation is, and is this sustainable? Are we going to be within the midpoint for long? Is it short term or is it long term? They looked at the exchange rate where we are. Is the appreciation a shock or is it sustainable? They also looked at the MTBPS, and there were marginal deviations from the budget, although it's a bit negative. They put us on positive outlook. They didn't change the ratings because we still have things to do. So the first thing that we still have to do is, while there's positive sentiment, we need to start seeing the fruits of the structural reform in the growth numbers. We have to look at whether fiscal policy will be able to get to a position where debt is sustainable, and the targets that they've set in the MTBPS, are those going to be achievable, and are we going to be able to reduce our debt to GDP stock? So basically, they're not going to base their decision only on sentiment. Sentiment can only get you to a certain position, but all in all, they want to see, they want to see the results of the sentiment and the results of the commitments that we have. I don't think a change in fiscal policy will only be because of sentiment, but it will be because of what the decisions that government makes will play a role. In terms of the foreign investors coming through, the recent numbers show marginal improvement, but of course one can associate that with positive sentiment. But as I said, the fundamentals will have to change so that at least the coming back of foreign investors is more of a permanent feature rather than a temporary feature. Thanks, Governor.
Thank you. Any more hands? Don't see any. Yes. That will be the last one.
Thank you, Governor. I just took an opportunity because there was no one again in the room. My last question would be, so I think it has been seen over the years that the South African banking industry has always absorbed, or rather reacted to, geopolitical issues all across the globe, or even nationally within the country. So my question is, with the current political situations globally, for instance, with the US having re-elected President Trump, and then here in South Africa with the current GNU governance, so what risk, or even more important, the opportunities that you foresee the banking industry of South Africa being posed with, and what is it that we can do as the industry to ensure that we catch the wave and benefit positively? Thanks.
Unfortunately, I do not give advice, and I expect banks to respond to the situation based on their own circumstances. Our team here will look at policies and what they mean. The politics is another matter. That's not a game we play. So you talked about the other president across the Atlantic. We don't know. We shall wait. When they say these are the policies, we will then quantify the impact of those policies on the South African economy. That's the best we can do. We can't try and deal with the politics. DG Mampo, over to you.
It's the moment I've been waiting for the whole afternoon, Governor. Happy holiday, everybody.
Thank you very much. Our refreshments outside, the team from the SARB will guide you. You can continue to interact. And for those who are too shy to ask the questions in public, you can ask them there quietly.